There is a third mandate from the Fed. What is it, and why is nobody talking about it? And could the recession be delayed until 2024? And if it is, how might you think about balancing your portfolio? This is a conversation well worth your 10 minutes right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore. Thank you so much for joining us. I'm here with my guest, Jeff Klingelhofer from Thornburg Investment Management. Jeff, great to see you. Thanks for joining us. There's certainly a lot happening that I want to ask you about, but I thought maybe we could start with the Fed and other central banks, but staying close to home, we'll stick with the Federal Reserve and Jay Powell and the job that he's got in front of him. So, I mean, it seems like that a pivot from them might be a little bit. I mean, listen, at this point, we're all guessing what's going to happen next. But you say that there's a third mandate from the Fed. Tell us what that is.
Sure. I think there is a third mandate. Maybe that would be the biggest takeaway for me, right? If you read the Fed's congressional charter, it is very clear that there is actually a third mandate. First, maximum employment. Second, price stability. But the third mandate, they actually call moderate long-term interest rates. So the key to this, to me, is when you ask former Fed officials, what they say is they don't know what moderate long-term interest rates are, but they view it as flexibility on how they pursue those first two mandates. And that's incredibly, incredibly important. Because looking forward today, we're now emerging from a period of below trend inflation in a period of sustained high trend inflation. But importantly, the sticky part of inflation today is wages. And I will make an argument that the third mandate today is one of social stability. It's compressing the wage gap, and that has huge implications as we look forward for when and if and how the Fed pivots.
Right. We were just talking right before we started about home prices, and especially younger people saying, I'll never be able to afford a home. And it's because of what you just said. I mean, you look at where wages are and where interest rates are, it's certainly less easy to buy a home these days unless you're, making, maybe double or triple your salary these days, especially where 7.25% interest rates on a 30-year mortgage. A lot different than when it was 3.25% a couple of years ago.
That's exactly right. I mean, we're having to relearn essentially what economics taught us back in grade school. Mm-hmm. The world hasn't worked the way we were taught that it's supposed to. Right? So I remember my experience of buying my first car. My parents told me, don't get in the trap of buying a payment. What you're buying is the actual debt stock. But for many folks growing up over the last 15 years, you did get lured into the trap of actually buying a payment, because in a world of zero interest rates and very low cost of borrowing, we've all been encouraged to borrow, right? So maybe that $80,000 car was actually affordable, and today it's not. But that's exactly true for your first-time home buyer. They find themselves in a pretty precarious spot trying to emerge into a world now of high interest rates.
And that's a really good point. A lot of those folks watch their parents do exactly what you described, getting very, very inexpensive loans, or basically 0% on cars a lot for many years, or low 30-year mortgages, and that's what they've learned to do, is borrow, because that's the right way to do it. It's good debt is what they say all the time. But nowadays it's tough to afford. And sort of piggybacking on that a little bit, where the Fed is concerned, when they're looking at obviously all of this data, and we've got jobs data from last week, and we're still showing unemployment declining, but we're looking at CPI soon, and we're expecting it to continue to fall. What is the Fed thinking? Do you think that they're going to hike again before the end of the year? And when will they start to pivot?
My own view, just to really quickly answer your question, I do think that they're going to hike. But to me, that's not actually the biggest question we need to be asking, right? It's when does the Fed start to cut? Because what the markets are pricing in is that we get to the peak. And it doesn't matter whether they hike one, maybe two more times. It's that first 500 basis points. That's what matters. That's where we are today. That's what is affecting consumers, corporations, the fiscal side of our balance sheet. But as we look forward, the markets are pricing in a near immediate cut to interest rates when we begin to see some softening. I think key to that third mandate part we already talked about is the Fed is no longer a proactive central bank. They used to be. They used to proactively raise the level of interest rates once unemployment began to dip. And that never got them to a 2% inflation target. So one of my central thesis is that as we look forward, the Fed is reactive. And they told us that before they started hiking rates, they had to see inflation above 2, and they needed to worry it was going to stay there. Right? That led to transitory. But on the way down, it's exactly the same in my book. It has to be below 2% trend inflation, and they have to worry it's going to stay there. So they're going to be on hold for much longer than we expect.
What about this recession? I mean, we're all expecting it every day. We expect it, and now we're thinking maybe it's not going to happen, maybe it'll happen, but not until next year. What's your thesis there? What do you think will happen with this supposed recession we're supposed to have?
Yeah, I think if I look at economic textbooks, if you told me the Fed was going to hike 500 basis points, 550 basis points, et cetera, I think we're seeing the cycle play out as exactly in the fashion that we would expect, just under a much longer time frame than we had expected. So this is to say we are seeing consumers weaken. We are seeing corporations pull back on CapEx plans, right? We are seeing sentiment deteriorate. We are seeing banks raise lending standards and ultimately pull back on the economy. So our base case belief is we are still headed towards a recession. My concern is that because the Fed is going to stay on hold longer than the market expects, we're still headed towards a relatively deep recession, unfortunately. And so that has profound implications for how we want to think about investing capital.
Yeah. Well, I'm kind of pivoting now to the portfolio construction part of the conversation because a lot of our viewers are looking at their own portfolios and thinking, what should I be doing here with so much kind of, unknown road ahead of us here. And you say portfolio construction is a little bit like a barbell when you look at, money markets and you look at fixed income. What are you recommending to investors right now?
Yeah, I think first maybe to touch on the point of money markets, right? I would say don't be lured into that sugar high of 5.25%, 5.5% interest rates. Yes, it's interesting, but it's a very finite time period. I think now is a great time to be moving into high quality, little bit longer duration fixed income, not terribly long, but locking in those higher interest rates for a more prolonged 3, 4, 5-year time period. But you're absolutely right about that barbell. There's tremendous opportunities with some interesting sectors of credit on the front end of fixed income, and you can barbell that with high quality treasuries and agency mortgages on the long side. Along with that, there's interesting opportunities within the international space on equities and within high quality, durable, income-oriented stocks.
Yeah, I mean, we're always, talking about the inverted yield curve, but it's inverting less these days than it was. 2 years are starting to come down, 10 years are starting to creep up. So given that, what should investors be focusing on as we're approaching the end of the summer, into the fall, preparing for year end? What are your thoughts there?
I'd say continue to watch the data. Watch the consumer, watch the consumer, watch the consumer, right? That is the key to figuring out where this economy heads. And we're seeing cracks within that consumer, right? We're seeing some of that subprime part of the consumer deteriorate. And really that is the key to us to suggest that we should be moving defensive, and we should be moving defensive today because there's not a big cost in terms of yield or total return potential to pivot your portfolio to defense today. If you're wrong, you're still getting 6.75% on the way. But if you're right, that's really where it pays dividends.
Terrific. Jeff, thank you very much. Great to see you, and thanks for joining us in the studio today.
Absolutely. Thank you.
Great. Jeff Klingelhofer from Thornburg Investment Manager, our terrific partners there. So make sure to follow us on social media, everybody. There's a lot more content up there for you, particularly on our Instagram page at UBS Trending for more there. And also, don't forget to check out our Insights website at ubs.com/views. And obviously, we talked a lot about what's going on in the markets today. If you have questions, make sure to contact your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. See you soon.